You often hear me talk about our job as traders is to try to identify when a change happens and be as close to when that change happens as possible. So right here, we got 1200 over 400 right here. Buyers over sellers. There are more future buyers and future sellers. Watch this flip when I just roll through. Just watch those two numbers down in here. Okay. Watch the flip from buyers over sellers. Boom, right there to sellers over buyers. Right there, buyers over sellers. And then if I just play at normal speed, this is flipped and there's a lot more sellers than buyers. You want to be able to catch that sooner rather than later. Later is down in here. Sooner is when we walk through it together. Plus, we got a pink triangle that was pretty decent. Plus, it was a breach of these two blue triangles, right? It was coming off of VWAP. There were more longs than shorts, and you could see the market come off. Why is that important? Because if your job is to read order flow, a lot of people that come to me might have found through their research of how to read order flow. Well, order flow is trying to predict future buyers and sellers, trying to watch them and read them in real time, and following other people's positions to anticipate where the future buyers and sellers are going to come from. We're trying to predict where price is going to go, but what we're looking for is predicting future buyers and sellers. That's what we're truly trying to predict. Are there going to be more buyers or sellers in the future? We think there's going to be more buyers than sellers in the future. You're bullish, and then hopefully long in locations where price does what you think it's going to do ASAP. All right. So you could go through all the data, all the numbers on your dome, all the numbers even on this chart. And it's broken down to what are you looking for? And when do you see what you're looking for kind of change, that shift? You know, the market is going to follow through faster, break out more often when there's something that surprises it. Price is going to become most jittery when something surprises it, something changes. The extreme example is a headline that could surprise everybody. An economic number that misses really big. The president comes out and tears up a trade deal that the market was all excited about. Whatever, something that changes is going to get the price to react faster. And our job is to be on top of changes as close to when they appear. Now, if I were to tell you in 5 minutes, oh, did you see more longs come in up there? Did you see sellers overtake buyers? That's less relevant, certainly less of an edge or any kind of advantage to be able to do something with it. And so that's when hindsight becomes 2020, and that's where a lot of indicators are lagging. You got to get something that allows you to read in the real time, number one, and number two, provide some predictive value where it increases the probability that the price should continue up or down or switch and go from bullish to bearish. And when that prediction, that call, that idea comes to fruition, it does not feel like a good guess. It does not feel like you're lucky, because if that's the case, it's not going to be consistent. You have to be like, all right, you're now objective. You made a prediction. It's going to rain this afternoon. Then it rains this afternoon. You don't feel lucky if you're the meteorologist. And what are meteorologists bad at? Predicting what's going to happen in 2 weeks. And they're less accurate at 5 days than they are in 5 hours. Same thing with trying to predict price. Think about it the same way.